And good evening, ladies and gentlemen. Happy Wednesday to you. I hope that all of you have had an awesome day and an awesome week. It's great to see all of you here. It's good to see Scott Anderson talking back and forth. He says it's our pleasure to ask them, but I have no idea who he's talking to. But I know Scott, so I know he's speaking of something positive and uplifting. So I hope that you guys have all had a great week, and I hope that you guys are ready to jump into Level 2, Class 8, which means tonight we're talking about Indicators Part 2. Indicator Part 2. Brad, I'm not sure what your commentary is. How do trading peeps, Jeremy? I think he's just asking how we're doing. Anyway, tonight in our discussion on Indicators Part 2, here's what we're going to be getting into. We're going to talk about a moving average review, which basically means we're going to review moving averages. We're going to talk about Bollinger Bands, and we're going to discuss the average directional index, and then we're going to have a little bit of a class wrap-up, seeing as this is the last class of Level 2, and when you leave here tonight, you're going to have a little break next week, give you guys all a chance to kind of process everything we've talked about, catch up on those quizzes that I know some of you are behind on, and then we're going to get back together here in about a week, and a little less than a week, 10 days, just after Labor Day. No, it's not just after Labor Day. It's a week after Labor Day. You guys are going to have a Labor Day in the middle. And when we get back together, Level 3, I think you guys are really going to love Level 3. I'm pretty excited about getting into that. But we will talk more about that at the end of class. So let's get rolling here. Let's not spend any more time talking about the overview. Let's talk about a moving average review. When we were back in Level 1, so this was about a month ago, actually it's about 5 weeks ago relative to tonight, we discussed moving averages, and I gave you guys a little basic moving average trading system. It was basically when the averages do this, you can jump in bullish. When the averages do this, you can jump in bearish. How many of you remember that? And more importantly, how many of you have tried implementing some of that in your virtual account and have recognized some success with it and recognize that that is a absolutely fantastic basic trading strategy? All right, Paula says me, and Lauren is doing it, and sure did, says Walt. A lot of you are writing in, and so very good. Randy says, I tried it without success. Well, Randy, keep trying it, because if you tried it without success, then it just means that you probably didn't try it enough. But keep working it a little bit there. And obviously, guys, I mean, please, 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 hear me. Do this stuff in your virtual accounts. Some of you listen to what I say, and you never test it, you never try it, and you go pop it into real trades and you wonder what's going on. And the truth is you haven't practiced it enough. And we're going to learn that when we get to Level 3 very quickly. That's the first lesson in Level 3 is about the trader conditioning process. So that's all stuff that's coming up. But as a quick review here, let me give you just a quick reminder of all the moving average discussion we talked about. We discussed how moving averages represent a smooth picture or a smoothed picture of the prevailing trend. So if you take a look at this picture over here on the right side, obviously the trend here is in an upward direction, but the stock is doing something like that. Well, the averages don't do the ups and the downs. Instead, the averages smooth it out, and you just see the nice little slow moving trend that goes through here. There's three signals that we can read from the moving averages. They are the trend direction, the entry trigger that comes from the moving average cross, and your support and resistance. Let's break each of these down as a quick reminder. From the trend direction standpoint, this is the very common usage one. This is the one that pretty much everybody understands about moving averages. It basically indicates if we're in a bullish or a bearish or a sideways type of a trend. If we're trading above the moving average, then we're in an uptrend. If we're trading below the moving average, then we're in a downtrend. And if the moving average is moving through the price action of the stock, then we're moving sideways. So, and then of course the angle, we discussed the angle of the moving averages. If you have a sharp angle moving higher or a sharp angle moving lower, that's generally going to represent a downtrend or an uptrend. And if the angles of the moving averages are going flat, that's going to represent a sideways moving market. Now, when we talk about the entry trigger, this is actually what we would refer to as a moving average cross. And basically what it is the moving averages are crossing each other, meaning that we've got multiple settings of the averages, and they're creating a cross like you see in this image here. The moving average cross indicates a buy or a sell signal. If we're moving downward, crossing downward, it's a sell signal. If we're crossing upward, it's a bullish buying signal. It's going to require at least two averages to create the signal, and it's a very strong signal of a new trend, especially when you have a good angle that goes with it. And the basic principle here is when the faster line crosses the slower line, it indicates a change in direction. Now, how do you know the faster line? Well, the faster line is always going to be the one that has the lowest number to it. So if we're dealing with a 10, 20, and a 50 period exponential moving average, the 10 period is going to be the one that has the lowest number. So obviously the 10 period is going to be the one that's moving the fastest. And then finally, the third way that we use moving averages is as a support and resistance tool, which also means that we can use it as a way to set our stops in the trades as well for a trend. As a support and resistance tool, the moving averages work as support and resistance. When we're above the averages tend to work as support. When we're below the averages, they tend to work as resistance. As you can see in this picture over here, notice that we've got retracements in this trend. The trend moved like this, but we retraced back up to the 20-period moving average in 4 opportunities here, actually even a fifth one that's all the way down here in the bottom right corner of the screen. So moving averages can work as a support and resistance. We're going to use the short-term exponential moving averages for this particular usage. As the stock falls down towards the moving average, the average tends to act as support. As we drop below the average average turns around and acts as a resistance. Let's take a picture here of all of the setups that we can have with the moving averages. Everything is on this screen. And of course, this works with any stock, any market, anytime. This is the simplest type of stuff that you can do here. But take a look over here on the left side of the screen. I've got it highlighted in green. We're above the moving averages. So obviously we're in a bullish trend, and you can see also that the averages are creating a support through here. As the trend was getting going, the orange or the 20 period was starting to act as support. We acted as support here in December. We acted as support along that 20 period in January. We acted as it in February. We dropped just below it and bounced right back up and acted as support at the end of February. We did the same thing here in March, and then of course as we got up to the top, we started getting exiting signals such as the bearish engulfing patterns that happened up here, and of course the averages started to flatten out. Here was the convergence of those averages. Notice how the averages are coming together. That is very often that signal that you're looking for to show you that the trend is done. Now, when you've got a situation like this one in the bottom left corner, take a look here. These averages are going flat while the bottom average is coming up at a good angle. That's not necessarily an end of the trend picture. Sometimes it is, but this one up here at the top is very often, because notice what happened up here at the top. Those averages started going downward. The 50 period started to flatten out, and obviously we were starting to end that trend, and you can see in hindsight what happened here. Notice the time period here in the middle. In the middle here, we've got basically flat averages. Averages are going flat here. The price action of the stock is going up and down beyond the averages all the time. There is no trend. And of course, if you drew your support and resistance lines in here, then obviously you would notice that there is clearly a channel going on here. So a channeling stock is going to be a time period where the moving averages are not very friendly. They do not help you very much. You're going to get a lot of moving average crosses in here, but they're all pretty much going to form a flat line or very close to a flat line, those crosses, and they very often are not a good signal. Now let's come on over here to the right side, and you're going to see that, yes, we dropped below the averages, but more importantly, and this is where you blend the two analysis skills together here, more importantly, we started to break below support. And so we broke below support. That down arrow means below. So we are down below support, okay? And we've got the moving average cross after having broken below support. Got the moving average cross. We've got good separation in the averages. We've got really good strong bearish angles. We're below the moving averages. It's pretty clear that we're getting a bearish trend shaping up here. And of course that trend moved for a couple of months here and had a fairly decent move proportionally for this trade. Moved from about $26 a share all the way down into about $19 a share. Actually really low levels down around 18. So it's a pretty good size move proportionally for the trade. All of those signals came from the moving averages, and again, I just can't emphasize it enough. If you've not had success with the moving averages as a trending tool, part of it is the markets have been a little bit choppy lately, meaning they've been going sideways, but I really, really, really cannot emphasize enough how much you need to keep practicing this, working with it, see how it works. This is an excellent, excellent tool for you to use, okay? So I really want you to to grab that. All right, that's my overview for moving averages and my quick review. Any questions about moving averages before we move forward? And while you're typing those questions, I see a couple of you. No, it's just one of you. Sorry, it's just one of you. Brent has been struggling to find the notebook. The notebook should have been posted. Paul told me he posted it. It should be up there. I think he also sent the email out giving you guys a link. You should go to the website and download it if you have not done so, because later in the day, after he did the initial post, I sent him a couple of edits, and there's just a couple small, and they're very, very small, but just a couple small changes and upgrades to that notebook already that you might want to take a look at and have available to you. So there's my little brief announcement. What questions or comments do I have on moving averages, if anything? I lost my questions tab here. There we go. Which is the faster line again, says Glendon. Glendon, it's the one that has the lowest number. The lowest number. So if we have a 10, a 20, and a 50 period exponential moving average, the 10 period would have the lowest number, so it will be the fastest. Okay? David says, how important are the weekly moving averages compared to the daily? David, interesting question. Let me see if I can interpret it a little bit better. When you say how important, define important. Weekly moving averages are going to be more important on the sense that they're dealing with a larger trend level, less important from the day-to-day trading momentum. Does that make sense? Excuse me. Sorry about that. Brad says, should we use exponential moving averages on all moving averages as opposed to simple? Brad, you can do that. But Brad, what I do and what I've set your templates up as in Trade Navigator is the short term, that's the 10, the 20, and the 50, I set up with exponential. And the long term, which I use the 100 and the 200, we use as simple. And so, if you want to make those longer term exponential, then you're not going to hurt my feelings. You can make your own decisions about that. But I generally use the simple for those. Okay. Frank says, do you generally wait for 3 moving average cross before considering an entry? No, I do not generally. That is a signal, Frank. It's not the only signal. And sometimes you'll learn that sometimes those signals actually come late, and sometimes you've got a better entry much earlier. But the reason I gave you that system the way I did is because I wanted you guys to have a way to go ahead and start doing something in your virtual account and hopefully having some success without having a whole lot of analysis skills under your belt. Now that we're rounding out level 2, you've really got the majority of the analysis information. Now it's going to be a matter of applying it, which is where level 3 is going to come in. All right, so we'll be working on all that there. All right, got a couple smaller individual questions there. I'm going to let my moderators deal with those. I think I got the big ones there. All right, let's talk about Bollinger Bands, a very interesting subject and a very interesting indicator, which I almost hate to qualify it as an indicator, but technically it is an indicator. It's created by a man named John Bollinger. Came out of the 1980s. This is a picture of Mr. Bollinger. Some of you might have seen him on CNBC, or you may have maybe even seen some of his videos, or most of you probably have not been to a workshop with him. He doesn't teach a whole lot, but he is definitely still alive and well, and you can find him around the country in various places. Basically, the principles of the Bollinger Band is that it evolved out of the theory of trading bands, envelopes, and trading channels. If you're not familiar with those, it's okay. It's kind of a passé theory for the most part, in the sense that it came out of the 60s and the early 70s. During that time, there were several kind of evolutionary steps in the process of the trading band theories. The biggest ones that were the most successful are what we refer to and know as percent bands. Then the Keltner bands came along. This was really a major breakthrough, as the Keltner bands. And then the Donchian channels came along. The Donchian channels were one of the. It's really the predecessor to the Bollinger bands. In fact, a lot of people really still prefer the channels. Some of you might have heard of the Turtle Traders. That's Richard Dennis's group out of Chicago. and they use the Donchian channels quite a bit in the commodities world. Keltner bands and the channels are probably used a little bit more in the futures and commodities world than they are in the stock world. I don't know if that's a statistically correct, but I hear them talked about a lot more in those circles. I don't hear them talked about a whole lot in the world of stock trading necessarily at this particular moment in time. Part of that is because John Bollinger came along, and what he did is he took these ideas, but he introduced the volatility component to these more, I don't even want to use the word primitive, but more primitive forms of band trading. Take a look over here. Well, let me give you some band theory first. Here's the idea of the band theory. What we want to do is we want to contain the price action within the boundaries. So take a look here. You see we've got a line that's coming up through the top and a line through the bottom, and we're trying to contain the price action so we can get a good idea of the extremes of the range. Remember, when we're dealing with momentum indicators, we're dealing with those oscillators that are going up and down, measuring the swings of the trade. Well, trading bands do it from a different perspective. Instead of trying to measure the momentum on an oscillator swing, top to bottom, they're trying to say, okay, where's the maximum that it should go to? Where's the minimum that it should go to? This is the way that a band would think through the process here. So in a perfectly theoretical world here, we're trying to contain the momentum of the trade within the boundaries of the trading bands. That was the idea. When you look at a trading channel, that's obviously way too rigid. A trading channel is just going to be flat horizontal lines. But in theory, what the early traders were thinking here is they were thinking, well, what if we plotted that moving average? Go ahead and put the moving average on there. And then what if we added space above it and below it? If we could find the extension to where that trading range would be, we could contain it. And so that's the idea. They added a moving band on top and a moving band on bottom, which is all of it's built off the moving averages, which is why I put those averages back in here tonight to pull it together. But take a look at how they all worked out here. On the left side, starting the bottom left, we got the trading channel. This is the just the flat version, and it works great with support and resistance, but it doesn't help you one bit for anything beyond that. So the idea was, what if we could get a moving average in here? We know the average would come through here and kind of form out that trading trend through there. So the idea is, what if we could put a moving average on the bottom and one on top, and then as the trade came down through here, the average would kind of come flat through here, and then we'd have the lower band, and then we'd have the upper band. That's the idea. Okay, well, you can see how this worked out. Percent bands, the idea here, it's the one of the first evolutions of the theory. You got the moving average right there in the middle, and then you got the band on the bottom, the band on the top. I didn't work really hard to set these bands here. The problem with percent bands is literally for every stock, you had to go in and change the percentage. It worked okay, but there was a lot of flaws. And so this particular picture really highlights the flaws. It really just shows it more than anything as multiple moving averages together. Now, the Keltner bands made a fairly decent progress in the process here, because what happened is we got into this place where if we were trading below the band, we were in a bearish trade, and once we broke back above it, then the trade was done. When we're above the band, we're in a bullish trade. When we break back below it, the trade is done. And so you can see through here, every time we break below that lower band, we were in a bearish move. When you break back above it, you're done with the trade. And you can see how that worked. It didn't work really super well, but it was definitely progress. The Donchian channels worked a little bit better. You can see how it contains most of the price action, and the formula was a little bit more mathematical. Well, I guess they're all mathematical, but it added more than just a percentage to the moving average in here. And so that's how you end up with these flat lines. And the flat lines basically say this is where support should be, this is where resistance should be. And you can tell that they actually works quite well. I mean, once it breaks down below support here, boom, we're going. And it kind of trades outside the band until you get to the next support level, and then it kind of broke down here. Then as we traded back up, it established resistance in about the right location, and then you can see that. I mean, that's fairly tradable. I mean, most people can look at that and say, hey, that looks pretty decent right there. But it didn't really catch. Well, I don't want to say it didn't catch on. It did catch on. It's just not the ideal usage. Let's just put it that way. John Bollinger improved upon it. So as we think through the theory, for those of you who care to work on the theoretical aspect of it, this is the real formula for the Bollinger Bands over here on the right side. I'm not even going to kind of try to pretend to tell you how you formulate it, because honestly, the computer does all the work. So why do we need the nerdy stuff when the computer can do it all for us? But if you want the formula, There it is, and it should be in your notebook. What happened is Bollinger realized that the real factor that was needed to adjust those bands was the volatility factor, and that's what was really missing. Volatility, of course, is when a stock starts to move substantially higher or substantially lower. We have volatility coming into the move, and if it's flatlined, then, or I should say if it's not trending, then the volatility has come out of the move. So the Bollinger Bands, what they do is they use a standard deviation formula to measure the bands off of the moving average. And then the result is we get a band system that expands and contains about 90% of the trading action of the stock. What happens then is the band actually is forecasting in many ways how high the trade could go. It's not really a forecasting tool per se, but it kind of outlines how high the trade could go based on the volatility that's coming into the move. So let's take a look here, and I'll show you what I'm talking about. Just starting over here on the far left, notice that while we're kind of trading in this sort of slow channel-esque, it's kind of a descending channel here, but pretty much all of the price action is contained inside the bands. Now, when we get into a really strong move, we have an actual trade set up where we start to move down below the bands, and you're going to notice that several days in a row, we're starting to push down below the bands. That got us into a very, very strong bearish channel. And look at what happened to the bands. The bands expanded and accelerated way down to allow for the trade to expand that far. Then once the trade stopped moving, here's the interesting signal. The bands kept moving because it was still factoring in the volatility. And as the volatility slowed out, the bands stopped moving. And that's one of your signals that the trade is slowing down. And then, of course, we got back into kind of a sideways move here. And for the most part, we're contained pretty much inside the bands. We started to have a breakdown here. Didn't happen as we traded back up to the moving average. Traded back down one more, but look at that tweezer bottom. Told us, nope, not going to happen. Traded back up here. And you can see about 90% of the trading action of this stock is contained within these bands. Over here on the right side, you got a nice little channel that's happening, all contained within the bands here. And so the idea, again, is to contain the price action, give us an idea of how high it might go or how low it might go. And if it is going lower in a trend, then the bands expand. For example, right over here, you see how the bands are expanding, allowing the trade to keep going further and further. And then as it starts to slow down, the stock will start to pull away from the band, and the band will start to slow down. And once you start to see that, then it's probably going to slingshot back in the opposite direction, at least to the point of the other band. That's the idea. All right, so in practice, what happens with these bands is we ended up with a few different trade setups, and those are the things that we're going to be talking about tonight. The first qualification of trade setup is the squeeze trade. The next one is the trend trade, and then finally, the reversal trade. So we're going to talk about all three of these tonight. Now, Brad has said, are you familiar with the acceleration bands? And he says, if so, how would you rate them amongst the others? Acceleration bands are a more modern band than even the Bollinger Bands. They were created by a guy named Price Headley, and he uses them a good bit. I've not spent a whole lot of time studying them. And the only reason is because I haven't needed to. That's just to be completely honest with you, Brad. I haven't needed to study them too much. Honestly, I think that you're going to get all the signals you need from the Bollingers. And, it's kind of like what I said in the last class on indicators. There's a lot of indicators out there. And 90% of them either do no good at all, or they just kind of mimic something else that's more standardized. And, in my trading, I tend to use the more standard tools, and I also find it very practical to teach you guys the more standard tools. Because, here's what happens. If I teach you guys the principles of an oscillator, and I teach you the basic oscillators that we use, and then you go and you find somebody else's oscillator that's new to the market, you're still going to know how to use it. If I teach you the basic principles of the Bollinger Bands, and I teach you the concept of band trading, and you understand how it works, then if you ever decide to move beyond it and look at someone else's specialized teaching on it, then you're going to have the foundation for it. And so that's really my objective, is to give you more of a broad base appeal. So that's the reason I've gone at it the way that we do. All right, now let's continue here. Squeeze, trend, and reversal trades. Let's talk about the squeeze. And by the way, this is the great trade right here. This is the one that everybody loves, the Bollinger Band squeeze. This is the best trade setup and the best signal you're going to get from the Bollinger Bands. It is John Bollinger's favorite trade. It is my favorite trade setup with the bands. Everything about it. This is the This is the one place that the Bollinger Bands shine beyond everything else. They're amazing with this little trade setup. And here's what happens. We have the two bands, obviously. When those two bands start to contract into a tight squeeze, it reveals low volatility. And you can see my picture over here. I got this is actually a great trade setup right here. Really, it's been going on for 2 months here. Really tight squeeze. When this thing busts out, it's going to be an explosive move. And so I love trade setups like this. Volatility can only stay low, I should say, for so long. And eventually it's going to break out. Now, it may be next week. It may be in next month. I don't know. But at some point, this trade is going to bust out into a new trend. It's a good trending stock. At some point, it's going to bust out of it. Well, when you know that, when you've got a trade situation like that, where it's set up to break out, but it's just completely flatlined. You might notice from our chart patterns class, this is kind of like a line pattern. You see that? Just pretty much it's going nowhere at all. And for some people, they'd say, I'm just going to give up on this trade. No, that's the trade you should be setting up. The very trade that most people are giving up on, you say this stock's going nowhere. That's the very trade. As soon as you stop watching it, it's going to explode. A perfect example of this is the Netflix trades. We've had like 3 of them in the last year, if I remember, at least 2, maybe 3, really big Bollinger squeeze breakouts on Netflix. And this is the same type of a setup. What would happen is the stock gets into a point where it's just not going anywhere. People give up on it, and suddenly, boom, it's explosive, and it moves $25, $30, $40. And you can really make a lot of money on moves like that. All right? Yes, LM, this is Sunoco. Yes. All right, volatility can only stay so low for a little while. When it breaks out, usually we have a really big new trend. So let's take a look over here. This one's on First Solar. This was a really good move that we had just a couple of months ago, actually. And notice that we had the nice bearish trend in through here. It was a big trend, moved down from $50. It had been even substantially higher. I mean, First Solar is just taking a beating. But watch what's happened here. The trade has come all the way down to the $15 range, and it's flatlined. Now, most people give up right here. This is exactly when they give up. They say, well, this stock has gone from $50 in the last 5 months down to $15, and I can't believe everything is horrible about this trade. You can't trade the stock market. There's manipulation, blah, 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 blah. You've heard all the stories. Well, let me just tell you what would happen. If you knew how to do your Bollinger trade, your Bollinger squeeze trade setup, watch where you would have gone over the next month. Kaboom, we almost doubled in less than a month coming out of this, and it was all set up with the Bollinger squeeze. That squeeze, notice that squeezing action here, showed you that the low volatility had come in. There was not much going on. You know this is a good trending stock. It's obviously shaking out the bulls and the bears. We've obviously got an equilibrium, but equilibrium is always short-lived in the market, and as soon as it blows out here, you know it's going to be a big explosive move. It's exactly what happened. We had a small gap out, small little breakaway gap out, and kaboom, there you have it. Pretty big trade, huh? That's the kind of stuff that you wish you could find every morning. And by the way, with the Bollinger Squeeze, theoretically you could, if there's one out there. Here's another one that's not quite as pronounced, but it's still very, very good in terms of the way it's set up. Notice that the bands are not squeezed together as tightly. Just take a look here. It's not quite as tight, but they are still squeezed together. The bands had contracted. And now watch the way that this one breaks out as we move to the right. Boom. And so in this case, we broke down. The breakout point was about $58, maybe $57, $56, depending on how conservative you were with getting into it. And within about 4 or 5 days here, it had traded down, $15 here, and pretty nice little move, especially if you're doing an option trade. These are great little trades, especially with options. So here's how we're going to trade the squeeze trade. We're going to set an entry trigger or an alert on the outside of the bands. Why on the outside? Well, because you don't know which direction it's going to go. It could go bullish or it could go bearish. So when the trade breaks, either bullish or bearish, you're going to be prepared because you've already got the trade set up. Now, there's an alternate way that you could do this, and the way you would do it is you could buy both a call and a put option, which creates the strangle strategy. I've not taught that to you, but some of you already know it, and it's not complicated. It's just simply, it's called a strangle, and you buy both a call and a put. Now, this is definitely not my favorite strategy for the Bollinger squeeze play, but it is a viable strategy. And sometimes it works out exceptionally well, especially if the options are very cheap. If the options are expensive, it's definitely not a good strategy. If the options are cheap, it can actually be a phenomenal strategy. We'll look at a setup here in just a second, so I'll show you how it works. All right, here's setup A. This is my preferred setup. Coming back to that first solar trade, the way you would look at this is you'd say, okay, stock has flatlined down here. We've got a great Bollinger squeeze. It's going to break out at some point. I'm just going to set a trigger. And it would just simply be a really simple order that says if, and in this case, it's if we trade above this price of about $16 here. So we'll say if we trade above $16, then buy first solar or buy a call option. Those would be the two orders that you should place. Either buy a call or buy or buy the stock. Okay, then the other one would be the bearish trade. You would do this one at the same time. If we trade below this price, enter bearish. So it's truly a bracket trade like I've taught you already, but we're going to set it on the outside of the bands. And then what happens is if and when the trade comes rolling out of here, boom, you get triggered in at $16. You've already bought your stock and you're ready to roll. Notice the first thing that happens is we traded right outside the bands. That's usually the first thing that happens. You get a nice little burst out. You have a corrective move. And then usually it sets up into the next strategy, which I'm going to show you is called the Bollinger Trend trade. Okay? Of course, the bearish trade would work the same way there. Now, here's the alternate way. This is setup B, as I'm calling it. This would be the strangle. This is specifically an option strategy. And the way you would do it is you'd buy a $16 call and a $14 put. And you're going to have to buy a little bit of time. That's where it becomes a potentially losing trade. And you got to hear me on this one. The benefit of doing a strangle at this location, and I'll just write this up here. The benefit is volatility is very low. Okay, so if you look at a stock like this, at a time like this, you're going to have volatility like in the 10 or 15% implied volatility on your option price, which means the options are getting very cheap, especially if it's a $15 stock. Now, if it's a $60 stock, maybe not so much. If it's a $600 stock, an Apple or a Google, definitely not. But on a cheap stock, if it's in the $15 range, it'll probably be getting pretty cheap. So volatility is really, really low, and what it does is it guarantees that you're in the trade, either bullish or bearish. Then if the stock breaks out bullish, you're happy because you own a call. If it breaks out bearish, you're happy because you own a put. So that's the strangle. That's the benefit. Now, the downside of the strangle, I'll put this in here. Downside is if you own a call option and the stock breaks out, what happens to your put? It goes all the way down to zero. So the downside is at least half out of these two trades, at least half is going to lose most or all of your money. And for some of you, that just plays with your mind. And you can't handle that. It just drives you nuts. So, for some of you, it's just a horrible trade. The issue with the strangle is you've got to practice it. You've really got to use it a few times in your virtual account, see how it plays out, see the money you're going to lose, because you are going to lose money on the trade. But in theory, the side that wins, so in this case it would be the call option, in theory, as the stock broke out and doubled in price, yet $16 call that maybe you paid $2 for would have become, gosh, what is about $10, $12 in the money. So you would have had a $10 or $11 option. So you would have had 5 times the investment. Okay, so let's say that you pay, let's say that you paid $2 for the call and $2 for the put. Well, the put goes down to zero, and the call would go up, in this case, to about $10. So you would end up with $8 profit here, minus $2 here. You'd still end up with a $6 profit. So you ended up with a good profitable trade, but it's complicated. So that's why I say it's not my favorite trade, especially for beginning investors, but it's an advanced strategy, and I did want to point out that this is one of those locations where you could use the strangle. You would definitely want the strangle, not the straddle. For those of you who already know what the strangle and straddle are, you would definitely want the strangle, not the straddle. The straddle does the same strike price. And anyway, I probably beat that one in the ground. That's probably all I need to say there. Paula says, what's the benefit of doing a strangle versus a contingency order? The benefit is you're guaranteed. Well, I mean, think about it this way. If this trade, let's say you did a $14 put, trade was currently at $15.90, and let's say you paid $2 for that. If this trade breaks down and goes down to maybe $6, you actually ended up making money for all of that move. It wouldn't be a lot because your delta would be fairly low. You might make 30 cents for every dollar, but it was a cheap stock or cheap option, so you're going to make money on it. So the benefit is you're in the trade already. The benefit of doing the contingency order is that you only get into one side of the trade. The other benefit of doing the strangle is you're going to have a lower cost to the option, because once this thing breaks out, the implied volatility on that option is going to go higher, meaning the cost is going to go up. But it's a more sure trade to do the trigger or the contingency. So, I generally prefer the contingency. I would be lying to you if I told you I have not done these as a straddle, because I have. I have definitely done these as a straddle. Some of them have played out profitable, and some of them have not. And so that's why I say generally when I see a Bollinger Squeeze, more often than not, it turns into a contingency for me. Okay? Does that help? Great. DG says, I'm confused. If you're confused on the straddle, just ignore everything I just said. I kind of said it for those who understand it. If it went over your head, just let it fly and don't chase it. Don't chase that bird because there's better birds in the air. How's that? All right, let's continue here. And let's talk about, well, obviously that's what happened with the trade. Let's talk about the trend trade. The trend trade is a trade that basically, it pretty much contains the trend. So, we've already talked about trend trading. We've talked about using the moving averages for the trends. We've talked about using your trend lines, etc. The Bollinger Bands are just another way of containing and looking at the trend. John Bollinger refers to this pattern as what he calls walking the band. And the idea here is just simply that the stock keeps running up into that trading band and it's walking the band. All right, so that's his idea there, it's walking the band. When you're in a good trend, the stock will stay between the upper band and the middle moving average. In a good bullish trade, I should say. So in a good bullish trade, we'll stay between the upper band and the moving average most of the time. And we're in a lower when we're in a bearish trade, we'll stay below or stay between the lower band and the moving average. So if it was a bearish trade, we would be staying right in here most of the time, about 90% of the time there. If you push beyond the band, that is a sign of strength. And then, of course, the way we trade it is we want to just kind of use the band as a way to help outline the trend itself. Take a look here. I really like this picture because it actually captures both a good bullish and a bearish trade setup with this. Notice over here we actually had a small Bollinger Squeeze breakout. And by the way, with the Bollinger Squeeze, sometimes this is the way it shapes up. Notice what first happened. It first started to break bearish. Immediately, it corrected, created a new line. Once you see that happening, get out of the trade because odds are it's done, okay? So first thing that happened is we had a little Bollinger Squeeze here. It broke bearish one day, immediately gave us a tweezer bottom, and it created a flat line here. You'll also notice that was a bit of a rising wedge pattern. You see that? All right, and then this pattern broke out, and then we got a really solid Bollinger break. And anytime you have the bands expanding, any expansion in the band is a picture of volatility, higher volatility. Okay, so you get in the trade bullish here, and notice what happens within this trend. We basically stay, for the most part, right inside the upper band and that middle moving average. Okay, that's walking the band. Literally, we're just trading right up into the band. And in Bollinger Bands, when you push up into the upper band like that and you get a close above it, that's a sign of strength. Now, don't expect to see 9 days back to back like that. Occasionally it'll happen, but more often you'll get 2 or 3, maybe 4 days where we push outside of the band and then it comes back inside and then it continues. Well, that becomes a buying opportunity right there. As we pushed outside of the band, if you didn't get into the trade, it corrected a little bit, pushed over to the moving average. And what do we already know about moving averages? Moving averages in a trend tend to act as support. Well, sure enough, that's what happens. So you can jump into this trade when you got that nice little bullish candlestick that created a little one white soldier pattern kind of on that trend line right there, which in this case is the moving average. Sure enough, the trend continues. We're pushing outside of the band for several days, and it kind of starts to take a rest here, trades over to the 20-period moving average, and the whole thing starts over again until the whole thing gives up. Now, once you start getting closes below the 20-period, you know you're probably out of the trade, and you know this trend is gone. A couple ways you know the trend is over. One, you start getting a lot of closes below the moving average. That's one way. Another way you know the trend is over is when the bands start to flatten out. Remember, they're built on moving averages. So when moving averages flatten out, a trend is flattening out. Same thing happens with your Bollinger Bands. When they start to flatten out, the trend is rolling over or it's done. Now come over here to the right side, and you're going to notice this nice bearish Bollinger trend trade. A lot of this actually took place inside of a channel. You see that right there. But as the trade really got rolling here, we did not have a nice squeeze set up, but we did start breaking below support. Real first break below support came in right here in May of 2011, around $32. We traded down into that lower band. The 20 period started acting as resistance. And you can see what happened is around here, we start getting evening star reversal patterns, shooting stars, and we start trading literally between the lower bands and that middle moving average for about 90% of the trend. I mean, it's very, very nice the way it contains the action. So the benefit here is that, again, we're pushing down below the band. We have a structure. We have a framework within which we can trade, and it gives us a good idea that, hey, if I have a nice bearish push, and then it corrects, oh, that's a good opportunity to re-enter the trade. Okay, so that's the way that the trend trade works. And, you know, is it better than the other skills that I've given you? I don't know. I can't say that because, honestly, I like trading with straight moving average crosses. Like, to me, that's just logical and obvious. But this is a very valid way of assessing a trend, and some of you might connect with the walking the band strategy in theory a whole lot better. I don't know. You know, every one of you are different, but, you know, hopefully that what I'm giving you here is I'm giving you a tool set that you can pull from. Let me give you an idea here of how we would implement this. In a bullish trade, as the trade pulls back, oh, let me say it differently here. I wrote different than what I was thinking. In a bullish trend, buy the pullbacks as they push higher. So we already saw that. I'll show you another example in a moment here. But in a bullish trend, buy the pullbacks as they push higher. In a bearish trend, sell the bounces as they roll over and continue down here. Okay, and then, of course, exit the trade when the trend looks weak, when it starts to pull away from the band, or when you hit your target, or for any reason, any other reason you feel like getting out of the trade. Pretty much the general rule of trading is when you start to feel uncomfortable, get out of the trade. Especially if you've got a profit. Get out, take your profit. You can't go broke taking the profit. And just know that, you got to trade. You're not feeling comfortable, get out. For whatever reason, just get out. All right, let me come over and show you some more examples exactly of this right here, giving you those rules. Watch what happens here in that trade as we pull back. In this case, it wasn't really a pullback. It was just a sideways move, but that creates your buying opportunity. The trend continues, new buying opportunity, new buying opportunity. And that's one of the ways that you can trade a trend here. It's kind of a little bit more old school, actually, where you're buying the pullbacks and riding the thrusts forward in the trend. Over here on the right side, notice this is actually a beautiful trade setup here. You have your initial breakdown. It trades back up. Selling opportunity, trades down. Selling opportunity. And when I say selling, I mean sell short or buy puts. Either way, it works in this trend here. And you had several all along the way down here. Another thing, I actually like this example too, because in the trend trade, a lot of times what will happen is it'll trade all the way to the top band and then continue. And that creates a really good opportunity for you as well. You can see that's what happened here. And it wasn't a huge move, but it was about a $4 move from about $24 down to about $20. I guess in practice, you probably would have only got maybe $2 or $3 on that. So it wasn't the greatest move there, but it certainly gave you some boundaries. All right. There is the trend trade, or shall I call it walking the band. All right, now let's talk about the reversal, and I hope to bring some clarification on this. After the Legacy series, I often had a lot of people confused on the reversal. So let me help you out with the reversal trade and maybe this will bring some clarification. The reversal is a way of identifying double tops and bottoms. To be completely honest, if we just broke it all down, that's what the reversal trade is. There's really two principles at play with the Bollinger Bands and the reversal signal that we get. Number one principle is if the stock is moving sideways, but the band continues to progress in the trend, it's a sign of weakness. Okay, so stock, take a great example right here on the right side of the screen here. Stock is moving sideways, but the band continues to go higher. When you have that picture, or in the case of a bearish trade, stock's going sideways, band continues lower. When you have that picture, it is a sign of extreme weakness. Okay, and then the second way that we use it, the second principle here, is really a variation of the classic reversing top or bottom. So let me talk about the reversing tops and bottoms. We've already talked about these with chart patterns. In a bullish trend, we get a top. So you've been a bullish trade, you had the top. Here's what happens, and this is the formula in Bollinger's. The stock makes a new high outside the band, and on the second attempt, the stock does not reach the upper band. So take a look here. This is the perfect picture of it. We traded up. We had a gap up. We had a new high outside the band. We pulled back. On the second attempt, we were way away from the upper band. When you have that happen, that is a solid reversal signal. Now, it doesn't necessarily mean the stock is going to go down, but it's a really, really solid, almost a given that the trend is done, and there's a high probability that the stock is about to reverse after the top completes. In a bearish trade, it's the exact opposite. When we're in a bearish trend, we create a bottom, the stock makes a new low outside the band, and on the second sell-off, the stock price does not reach the lower band. And when you have that, again, you've got you got a classic reversal coming into play. Let's take a couple looks here. Notice what's happened here on this trade. I'll give you a little bit bigger picture. This was the Garmin trade. We were in a nice, first of all, we had a pretty decent squeeze. It wasn't a tight squeeze, but it was a pretty decent squeeze. Had the breakout here. Had a great walking the band trend trade. Had a gap out here. By the way, you guys already know about gaps. So what classification of gap would this be? What would this gap be? An exhaustion gap. Excellent. Exhaustion. Everybody who said exhaustion, you're totally correct. Do you see how this exhaustion gap immediately started coming down to fill the gap? It never fully filled it. It tried to make a higher move, but we were so far away. There's no way. Anytime you see a picture like this where the stock is pulling away from the band, it's a sign of weakness. We actually have another one right here. It's not a really strong trend that we were in, but we did have a Bollinger squeeze. It broke bearish. It had a decent little move. I mean, it's $3 or $4. But watch what happened. It started to trade sideways, and the next attempt did not make it to the band. Did not make it to the band, and it gave us a hammer. Well, if you're not making it to the band and you're getting a hammer candlestick, and if you can look back to the left and recognize that, I just filled the gap. That's a pretty good idea that trade's done. You see what I'm saying? So a lot of trading, so much of trading is